You just won't believe what's happening in the market right now. New spot ETFs are already in their final stage, and the US and China are getting closer to ending their tariff war, and the Fed is preparing a decision that could turn everything upside down. But where is all this leading? Will ETFs really become the trigger for a new bull run? Why is gold surging while the dollar weakens? And what does this mean for Bitcoin? Are we standing on the edge of a major reversal or facing yet another hit to the market? Friends, today I'll show you what most people still aren't talking about. Get ready, it's going to be intense. Before we begin, this is not financial advice. Everything I say reflects my own view and analysis of the market. Use it as an additional perspective, not as a call to action. Canary and Bitwise are launching funds on Solana, Litecoin, and Hedera, and this could become one of the most important events for the crypto market this year. For the first time in the US, spot ETFs on altcoins will appear on NASDAQ and NYSE. The key difference is that these are not experimental derivatives but physically backed trusts, where the only asset of the fund is the token itself, Solana, Litecoin, or Hedera. Custody is provided by licensed custodians, including Coinbase Custody and BitGo, as officially stated in the S-1 filings. Legally, this launch became possible thanks to new SEC rules adopted in September. The Commission allowed exchanges to list crypto ETPs under generic listing standards, without needing individual approval through Form 19B-4. This opened a regulatory window, which Canary and Bitwise used even amid the government shutdown. Now exchanges can launch crypto products faster if they meet basic transparency, liquidity, and custodial control requirements. But the question is, how much will this actually impact the market? Even a physically backed ETF isn't a guarantee of capital inflows. The effect will depend on AUM, assets under management. If these funds quickly gather hundreds of millions of dollars, as Bitcoin ETFs did, institutional demand could become a new driver for Solana, Litecoin, and Hedera. But if the volumes stay weak, the market will get another loud headline without real impact. It all depends on whether major brokers, pension funds, and corporate traders take the step to invest. Even with physical backing, tracking errors are still possible, not because of swaps this time, but due to fund fees, delays in share creation/redemption, and the gap between market and net asset value. Such distortions are common for commodity ETFs, and their magnitude will show how efficiently these new funds work in real conditions. Ultimately, we're witnessing the moment when altcoins are getting their chance at legitimacy. Yes, these ETFs are only the first step, but a very important one. They open the door to institutions that previously couldn't buy SOL or HBAR directly, giving the market a chance to test whether demand for altcoins exists beyond speculation. If these funds show real inflows, we could see the first wave of liquidity moving beyond BTC and Ethereum. If not, it will become clear that the altcoin market isn't yet ready for the big leagues. By the way, right now I'm recording my next video about some very interesting altcoins, so make sure to subscribe to the channel so you don't miss it. And let's move on. The situation in the US right now feels like a movie. The lights go out, bureaucracy slows to a crawl, and everyone's waiting for the economy to blow up. Since October 1st, the federal government has been officially in shutdown mode, meaning most agencies are either closed or working without funding. Congress failed to pass the budget, and the consequences are already visible. Delayed salaries, courts sending employees on unpaid leave for the first time in nearly 30 years. According to White House estimates, the economy could lose up to $15 billion in GDP every week if no deal is reached. And what's worse, key macro data simply isn't being released, because the agencies that publish it are also closed. That means the market is now flying almost blind, with no official reports on employment, inflation, or GDP. Amid all this, another storyline is unfolding: the trade chess match between the US and China. Media reports say that ahead of the planned meeting between Donald Trump and Xi Jinping, both sides have supposedly agreed on a new framework for a trade deal. But as Reuters notes, it looks more like déjà vu. Nice wording, but no concrete commitments. Meanwhile, China is actively signing new deals with ASEAN and Latin America, strengthening its own supply chains. The US, in turn, has reopened investigations under Section 301, essentially accusing China of failing to fulfill its Phase 1 commitments. So officially, it's dialogue. Unofficially, the cold economic war continues. For the markets, that means one thing: maximum uncertainty. If the deal is finalized, lower tariffs could give a much-needed boost to industrial sectors and, indirectly, to the crypto market. And even though the game is still happening behind the scenes, it feels like we're getting closer to a positive resolution. And if you want to be the first to know when it happens, make sure to subscribe to my Telegram. I share updates there faster than anywhere else. The link is in the video description. And now, the Federal Reserve takes the stage. We're seeing more and more signs that Jerome Powell and his team are preparing to ease policy. The next meeting is scheduled for October 29th, and according to CME FedWatch, over 80% of analysts are already pricing in a 0.25% rate cut. In other words, the market is almost certain that the tightening cycle is coming to an end. And this isn't just speculation. Powell himself has said several times that the end of balance sheet reduction, EQT, could come within the next few months. QT, or quantitative tightening, is when the Fed reduces the size of its balance sheet, effectively pulling liquidity out of the market. If this process stops, it means money is flowing back into the system. More capital, more lending, more risk appetite. In other words, the conditions for crypto growth are better now than at any time in the past year. Powell also pointed out in his latest remarks that the labor market is weakening, hiring is slowing, layoffs are easing, and overall momentum is cooling. That gives the Fed an official reason to cut rates, to support economic activity. Overall, this is a bullish signal. But let's be clear. A rate cut on October 29th doesn't automatically mean Bitcoin will skyrocket to $120,000, or that alt season will begin. Why? Because all of this is already priced in. Bitcoin has been recovering over the past week exactly because the market anticipated it. In my previous videos, I shared my thoughts on Bitcoin's next moves. What scenarios do I see? The base case for the next 2 to 4 weeks. Trading in the 107 to 115,000 range with a gradual recovery toward 116 to 118,000 if macro conditions remain neutral and we see stabilization in spot ETF flows. Let's check if I was right. The video came out exactly a week ago, and since then, we've been trading in the same range I mentioned. The situation is slowly stabilizing. The US and China are moving, awkwardly but still, towards some form of agreement. ETF inflows have turned positive again, and only one day last week saw outflows, which were quickly offset by 4 straight days of inflows. Here's the key point. If the Fed cuts rates, we may see a brief sell the news reaction, but it'll likely be short-term. If they decide to hold rates steady, we'll still see a sell the news event, just in a more panicked form. Either way, these are temporary moves. Back to the US and China. The conclusion is near. It's simple. If they strike a deal, the market goes up. If not, uncertainty stays. Add to that the launch of new altcoin ETFs, or if demand turns out strong, we could easily see a major reversal upward. What do you think? Let me know in the comments. Friends, thanks for watching. Don't forget to like, subscribe, and leave a comment. And remember, this video is not financial advice, just my personal view on the market.